If the price of silver goes from, let's say, $20 to, let's say, 90, let's say $100, for example, that's an extra $80 on the cost of your $50,000 car. So it's neither here nor there, but they can't stop the entire production line because they can't lay their hands on silver.
And I've been hearing also, I think it was a Silver Academy on Substack, that silver was trading above $130 in India. Last year in the city of London's physical silver market, the world's largest, has revealed that London holds almost no physical silver relative to the billions of ounces of cash spot market contract claims for immediate silver bar ownership and delivery that have been sold and stand in the London silver market.
Rising silver prices are fueling debate across global markets, with analysts noting that even a jump from $20 to $100 per ounce barely impacts high-value manufacturing like a $50,000 car. Industry observers argue production lines won't halt over silver shortages alone. However, reports of silver trading above $130 in India and alarming revelations from the London physical silver market are drawing attention. Despite billions of ounces in paper claims, London reportedly holds minimal physical silver for delivery. Commentators such as Clive Thompson and Innecco highlight this imbalance as a critical risk, signaling potential volatility and a looming reckoning in global silver price discovery. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
Last year in the city of London's physical silver market, the world's largest, has revealed that London holds almost no physical silver relative to the billions of ounces of cash spot market contract claims for immediate silver bar ownership and delivery that have been sold and stand in the London silver market. So, and it says, as a consequence of this, of the diffusion of this knowledge, it would be expected to see startled owners selling those claims to London bullion bank operators, taking their USD and securing rapid physical delivery elsewhere. Due to the scale of the London problem, securing of silver in other markets would be expected to be akin to a quietly but quickly building rush. And he says, on January 7, 2026, data from COMEX, CME COMEX market shows how this delivery rush for silver may be increasing, keeping in mind that in addition to New York, we are seeing price premium for silver delivery in other global markets, ex-London, indicating accelerating silver buying elsewhere. So here we go, January 7th. So holders of 1,624 January silver, which is not the front month. So here, so he says, he notes here on January 7th, holders of 1,624 January 2026 silver contracts, so 5,000 ounces per contract. They received delivery of 8.1 million ounces of silver delivery warrants for COMEX warehouses, with JP Morgan delivering 99% of the total to numerous stoppers, receivers of the metal. So the interesting thing is, Clive, and you know that, is the January contract it's not really the most traded one. We've never really seen this happening. And he notes as well, which is interesting, that the open interest as well went up. So it says here, what is interesting is that despite this contract delivery yesterday, the open interest for January increased by 1,431, ending the day with an open interest of 2,155. What that means is that someone went in there and bought probably another 1,431, or several people. And why would they buy a contract that's not trading like really liquidly? Well, because they want the physical. And I think this is really significant, Clive. And
so this could be a manufacturer of end products which uses silver, and they want to be absolutely sure they can secure the supply.
Yeah, but but COMEX has never really been a physical market like it has been. I remember you looked at the deliveries last year. They were much larger than the previous year, and I think it's continuing. And you can see here they're doing the same thing for February. The open interest in February is 3,400. And look at it. I dread to see what will happen when we get to March, Clive.
Yes, a lot of open interest, which might, 104,000 contracts of 5,000 ounces each.
Yeah.
I can't do the maths on that, but there's a lot of ounces.
But of course, the March, sorry to interrupt, March is actually the mostly traded contract. So that open interest will drop, but it will be interesting to see what it is in March itself, which is when you can start taking delivery, right?
Yeah, and obviously probably going to be mathematically impossible for all of that silver to be delivered. So most of it will be rolled over, but it will be interesting to see if the delivery amounts are higher than usual. Every month last year, the deliveries taken in COMEX were higher than they had been in the previous year, and significantly so, mostly by more than 100% higher.
Yeah, yeah. Um, Clive, last yesterday afternoon, late afternoon, or I don't remember exactly, this news came out. Glencore and Rio Tinto resumed talks on 260 billion mining mega deal. Discussions over a tie-up to create world's largest mining group come as race to secure copper reshapes the sector. And I think they do a lot of coal and iron ore, these two companies. But I think, and I want to know what you think for as well. But I think this is not. Yeah, it's about copper and coal and iron ore mostly, but I think this is going to spill over even into the precious metals because, as you say, people need the supply. The silver shortage as well and deficit has been accelerating, right? So yeah, how do you see this piece of news?
Well, I think it's related to the commodities sector in general, which brought apart from the precious metals recently has, broadly speaking, been in the doldrums. And I think the expectation is that commodity prices are on the cusp of moving up to reflect the general level of inflation we've had over the last decades. So, the when you combine two very large companies, you get huge economies of scale in terms of you don't need two personnel departments, you don't need two accounting departments, you don't need two management teams, and so forth. So I think they're gearing up to benefit their shareholders effectively from the higher commodity prices to come and from the efficiencies that they're going to need as demand increases.
Mounting stress in global silver markets is drawing attention to a potential physical supply crunch. Data from London's bullion market suggests massive paper claims vastly outweigh available physical silver, prompting investors to seek delivery elsewhere. COMEX delivery activity in January 2026 surprised analysts, with over 8 million ounces delivered and open interest rising in a non-liquid contract, signaling urgent demand for physical metal. Observers like Clive Thompson note this trend mirrors last year's record deliveries. Meanwhile, renewed Glencore-Rio Tinto merger talks underscore a broader commodity awakening as inflation, industrial demand, and accelerating silver deficits reshape global resource markets. Let's get back to the interview.
And I'm not thinking here, what's the best, most attractive asset? I must have all my money in that. I'm thinking, sure, gold is a very attractive asset, as is silver and other precious metals. But I'm not thinking, right, because it's the most attractive, I have all my money in that area. I'm thinking, how can I prepare for the eventualities that we don't know what the world holds tomorrow? So I should have some in that asset, but I should have some in the assets, in other assets, which might do well as well.
No, I agree. So here I've got S&P index to gold ratio, and it's been like topping, I would say, and I think this 145 level here, that's really important. And in 2011, we got to 0.59, so I guess you only needed 0.59 of a troy ounce for one S&P. And let's put it on the monthly basis, so we'll go back a bit further. Yeah, I think there's a lot of room for gold to outperform the stock market. Um, in 1980, you only needed an eighth of an ounce, basically. So, yeah, pretty interesting.
I agree with you. I think everything for me points to the gold price continuing to outperform stocks uh, over a reasonable period of time. We don't know, it's hard to put a date on it or a time, but I think if I was having a 1 year bet, I'd say gold will be the better bet.
Yeah, yeah.
Not That's not investment advice, it's a personal
No,
opinion.
yeah, no, I
But
agree.
the underlying story about gold and equities kind of points in that direction. Equities are at a higher valuation there than their historical norm in terms of price earnings ratios and multiples and growth.
Yeah,
So they're kind of high. And gold has an ever increasing number of factors coming in, like geopolitical uncertainty, higher inflation, the bond crisis that we're going to go into. All of these things are pointing in the direction that there will be a generalized move into gold, particularly from portfolio managers over the next years to rejig their portfolios so they start to include gold. And that, to my mind, means that the prospect, they're not going to, I don't think people are going to be saying, I need more equities in 2026, but I think they will be saying, we need more gold in 2026. And so for me, that kind of points in the direction of gold being the better performer.
yeah, and I think you can look at silver as well and the ratios. It's the same thing for silver. But one amazing thing, Clive, is that maybe they're starting to wake up a little more to gold and silver. But I think the vast majority of professional and even just regular investors, they've got no clue what's going on in terms of these ratios, and I think they're going to lose out.
Gold and silver are increasingly viewed as strategic portfolio hedges rather than all-in investments. Analysts point to the S&P 500 to gold ratio, which appears to be topping near historically significant levels, suggesting gold is poised to outperform equities over time. Clive Thompson highlights that equities remain richly valued, while gold benefits from rising geopolitical risk, inflation pressures, and an emerging bond crisis. Similar dynamics apply to silver when examining long-term ratios. As portfolio managers rebalance toward hard assets, precious metals may gain broader institutional support, leaving many uninformed investors at risk of missing a major shift in asset performance. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.